All right, Ben, we've got a very special guest today who's going to talk about a unique concept, also in the home deposit space. We are talking with Michael Ragavan, who is the founder of Our Leg Up. Welcome to the Property Couch, Michael.
Thanks, Bryce. Pleasure to be here.
Good to have you, mate. We are excited to talk to you because you've been innovative. You're looking in the market for opportunities to find a niche that helps people get into the property market. So my first question for you, Michael, is with your product, what is the problem that you solve?
Yeah, so we're really interested in diminishing wealth inequality. And the number one driver of that in Australia is not owning a home. So that's exactly what we're going to pursue. Homes are our largest asset for most Australians, generally the most important wealth accumulation vehicle. But it's a shame that cost of living is increasing, interest rates rising, inflation rising, and many Australians are just locked out of the market and risking their future financial security. So we're tackling the biggest barrier to home ownership, which is that 20% deposit.
Yeah, it's tough, isn't it? So you're going after that. You're trying to help firsties get into the market with giving them a leg up, hence the name of the business, of this startup. Now, I should point out to our listeners that we're getting a very early look at your opportunity because this is for those folks who are interested in stuff. This is ground floor opportunity to hear what we're chatting about today. But okay, so if you're trying to solve the problem of deposits, how do you solve that problem?
Yeah, sure. So we're looking to get aspiring homeowners in with just a 5% deposit and without needing to pay the additional LMI charges or interest rate premium that comes along with it. So really getting in many years faster for just 5%. And how we do it is by creating a community around home ownership. So on the other side of the market, Aussies have a majority of their wealth tied up in real estate. And we've figured out a way to be able to access it and leverage it so that both sides of the market can win. So on the other side, your house, it's usually your largest asset, but there's really nothing you can do with it whilst you live in it. There aren't any dividends, there aren't any interest yields. Instead, you're paying council rates, you're paying taxes, there's maintenance. That's why Rich Dad calls it a liability. It takes money out of your pocket, it doesn't put anything into it. But Our Leg Up has changed that. We've developed a platform to unlock Australia's largest source of investment capital, your home equity. So how do we do it? Well, we aggregate equity, not cash. And we take a charge against essentially the established homeowner's property. And then we provide it to the bank. And the bank can use it to cover the aspiring homeowner's deposit shortfall. So in this way, the bank pays us a fee for lowering their risk. We essentially distribute that as returns to the established homeowner. And the aspiring homeowner, well, now they only have an 80% LVR home loan and they can get in faster without the additional cost involved.
Wow.
There's a bit to lean in on, Ben.
Look, we are fortunate enough. We get reach outs from people all the time on the Property Couch around sort of innovation and what they're trying to do so they can get their message out there. Now, we were fortunate enough a while ago to have Michael reach out to us. And obviously, a lot of people that do reach out to us, we want to make sure that it's in the best interest of our community. And this is why this is a bit of an exclusive, because what Michael's talking about here, just so we can get some context. So LMI at anything above 90 to 95% is quite expensive. Like we're talking, especially with the size of mortgages that we have to get these days. So we're talking in the sort of tens of thousands of dollars that it costs to have a loan to value ratio in that sort of space. If you want to get a mortgage and you want the bank to insure themselves against you as a risk, that's what lender's mortgage insurance does. Now, what's also interesting about what's happened in the last couple of years is that lenders are also now pricing in LMI into their interest rates. So the risk of the higher loan to value ratio, you actually start receiving or getting charged a higher interest rate on the money that you need to pay back for the banks. So what Michael's proposing here is quite interesting in the sense that if you get that LVR below 80%, you're actually at some of the most competitive interest rates from those particular lenders. But again, Michael, this is a novel, inventive product. And the other side of that you're talking about there is potentially getting a return on investment out of the equity. And of course, a lot of our community are investors, and a lot of that community may not be able to continue to keep investing into their portfolio because of the current situation. But this is potentially an opportunity for either, again, home equity or investors who have equity in their investment properties to potentially get a return. So talk us through that piece in a little bit more detail if you can.
Yeah, sure. So home equity is actually the largest source of capital in Australia. It's 7.2 trillion after mortgages. It dwarfs the ASX at 7.2. It dwarfs all the Australian super funds at 3.4 billion. But it sits there and it's largely uninvestable. And so we've figured out a way to tap into it and help generate a return, roughly 3 to 5% per annum. And so how do we do that? It's by taking a charge against it and providing it to the bank to diminish their risk when it comes to these aspiring homeowners loans. And in return, they give us a fee and then we distribute that. And so what's interesting there is that what we would deem as inaccessible equity, so literally equity that you can't access, that you can't get a loan against, that you can't go out and buy a property for, which has a $0 cost of capital, opportunity cost, suddenly has a rate of return that can be as high as 5% per annum.
Now, you have an investment banking background, Michael. So for those who don't have an investment banking background, break down a charge. How does the charge work? What does that mean? And why are you getting a fee for providing the charge, which you then distribute to the investors?
Yeah, sure. So a charge, we call it an equity investment. It's essentially a mortgage and a guarantee that's taken over the established homeowner's property. There's no cash involved. It's just that guarantee. And we aggregate that and provide it to the bank. And for the bank, it lowers, this gets a bit technical, but their risk-weighted asset, and it stops them from paying essentially their most expensive form of capital, source of equity. It's called common equity tier 1 capital. For that, they pay us a return. And so we distribute those returns to the investors. And suddenly they have inaccessible equity, which they couldn't get a loan on, which they couldn't use to buy another property, with a $0 opportunity cost, now earning a return between 3 to 5%.
All right. I've got a property that has a 50% loan to value ratio. Now, if I want to continue to keep investing, Michael, I might want to use 30% of that for a deposit for another property in the future. But I still have a remaining 20%, which takes me up to the 100% of equity. So are you just talking about potentially, you might have mentioned that it's the equity that may not be accessible in the first instance, because in theory, as an investor, I probably don't want to go up into the 90s or 100% sort of loan to into those high LVRs if I'm a mature investor. Is that the sort of area that you're talking about? And when you say an equity, is that a caveat that's placed on the security of the property?
Yeah, sure. So generally investors over the years, their income will grow, but certainly the size of their portfolio and the equity in their portfolio grows much faster. And so their ability to borrow against the entire amount, even at the 80% mark, isn't going to be quite there. Perhaps they can borrow against 70% or 60%. And so we go up to that 80% mark in terms of taking a charge over it, and we take a mortgage over it. So not necessarily a caveat, it is a second ranking mortgage, but it has no loan associated with it. So there's no interest or there's no cash out associated.
That makes sense.
Yes, it's lazy equity, for lack of a better term. It's equity that's sitting there that can't be utilised, that you can actually then return. So okay, so that's how you fund what you're doing and provide interest to the investors to give the charges up so that they can then give it to the bank so they can lend it. What about the person who wants to buy their first home? Let's talk from their perspective.
Yeah, sure.
How would they use your product to actually help them overcome? Ben sort of hinted early on around the premium for interest rate and the high LMI. How do you overcome those two things?
Sure. So instead of having to pay LMI, instead of having to pay a premium interest rate, they pay a much lower fee. And so if we take an example of a $600,000 property with a 5% deposit, so $30,000, generally the LMI there would be 4%, so $24,000, and there'd be an interest rate premium of say 0.2, 0.3%. With using our leg up, they would save over $13,000 in that example. And so it's quite a significant difference. And they can access the product from any of our partner banks, similar to how they access LMI, just a tick box that their broker or themselves can select when they apply for their mortgage.
So, Michael, that's obviously And this is the sort of first time this has probably been more broadly communicated out into the marketplace. So we're calling it exclusive on the Property Couch here. But tell us about where you're at in terms of the product journey, because this is serious innovation in this space. So tell us, where are the legals at, where are the negotiations with the different banks at, and what's next, I suspect, is the question.
Sure. So this has been in development for about 14 months now. And before we started any of it, we wanted to make sure that it made sense, that it was a positive sum relationship for the aspiring homeowner, the established homeowner, and the bank. And so there was a lot of financial engineering, credit models, risk models that went behind it. And then once we figured out that the numbers stacked up, we spent a lot of times essentially going through the legals with tax barristers, financial services lawyers, the whole range. It's cost quite a bit, but we've got 90% of our investment product suite ready to go. And we're also in discussions with 2 large banks who are quite keen on distributing our product. And we're pretty close to getting it out. So hopefully you'll be able to see it in market first half of next year.
So someone goes, "Oh, this sounds pretty good, Michael. I think I'd love to find out where that tick box is where I can put that in." So how do they know if they're an ideal candidate? How do they know if that tick box with their mortgage broker or their lender actually works? What's the typical profile of a first home buyer look like to qualify for this?
Sure. So anyone who has genuine savings of 5% who's looking to purchase a property, in most areas around Australia, there are certain places that we avoid, so mining towns and things along those lines. But essentially, most areas around Australia with a 5% deposit is really what we look at. In terms of how they would go about the process of applying, essentially going to their broker, and if they have our partner banks on their panel, then they can easily select us when they apply instead of LMI.
So there's an education process which, let's say hypothetically the 2 banks agree this is going to be a product. They've obviously got a business development team of people that go out and they will be talking to the brokers about this as being an alternative option. And so that will get the message out to brokers. And then as a broker, so I put my broker hat on, so I'm now educated that you're talking about not taking that last 20%, but looking at potentially, if I've got a 40% loan to value ratio in a static asset, I've pretty much got my portfolio built, but I'm looking at some top up yield and some top up income. I can potentially lend 20% or 25% of that through this scheme. The bank takes that and it's a triple win, like what you were saying before, in the sense that the bank obviously gets a loan. They're making profitability on that loan. You're getting the margin in terms of, obviously, because this is a better security, which means that the price of money that the banks are accessing that in the money markets, you're getting a differential of there, which is what is going to allow you to pay that 3 to 5% return to the property owner who's effectively putting a second mortgage on their property to receive income from that lazy equity. And then finally, you're bringing it in to sort of say, for those people who might have small deposit, but professional jobs, and they want to buy a more significant first home. But the reason why they didn't want to buy that significant first home was because the LMI premium was going to be in the 20,000+ range and the interest rates were going to be excessive. You've effectively reduced their costs. So they've also got a win and they're getting into the market in the first instance. So that sums up why my interest spiked when you first reached out to us, Michael, because I see this as being something that, this is what this episode's all about. It's about barriers of entry of getting people into property. And we're talking about homeowners, not investors here. We want every Australian to eventually own a home. And here you are giving us another vehicle to be able to do that. So for my final question, what I'm interested in understanding is, how do people learn more about what you're doing? So if I'm the first home buyer, where do I go to? If I'm the investor, where do I send my inquiries?
Sure. So www.ourlegup.com.au, we have a page for aspiring homeowners. We have a page for established homeowners. If you're looking to be on the other side, you can give us your email address or inquire, and we'll send you some follow-up material so that you can learn more about the product, see if it's suitable for you.
There are some very good sort of how it works through there. So my final question is still a tactical question for you, Michael, but it's is there limitations on price? Do people have to be first home buyers, or could they have owned property before? You know, Ben said you're not looking to help people buy an investment property, you're helping people buy their home. What sort of criteria do you look for eligibility?
Sure. So the only criteria is that you have at least 5%. You don't have to be a first home buyer. It can be for investors as well. So happy to support anyone trying to get into the market with a low deposit. In terms of the maximum, right now it's at around $3 million, but we'll work towards trying to make it higher.
Okay. What's the thought process in terms of helping investors as well as first home buyers? Are you just seeing like, well, it's an opportunity, we're providing an opportunity, we're not specifically just going for home ownership? Because I guess that was part of the, you know, the initial discussion at the top of this interview, that you're saying, you know, that's where the divide exists. Is there any reason why you're opening up for investors as well?
Yeah, sure. So our primary customer is the aspiring homeowner, and that's certainly who we want to benefit the most. In terms of helping investors, generally they would use the equity in their initial property to try and purchase another property. So it'd be unusual that they were to sort of go and use our product. But if they wanted to, then the way we think about it is perhaps they're rent vesting. And so they don't actually have their own property. They're still buying their first property, but it's a rental instead of one that they're going to live in.
Yeah, well, that makes sense from a rent vesting point of view. I agree with you that if I'm trying to release equity and go again, I'm not necessarily going to be looking at this product. But it comes back to your purpose and your mission, doesn't it, Michael, in terms of you're trying to ensure that you bring everyone along on the journey, as we love this idea that every Australian should own a property. It's going to be a critical asset as part of the wealth creation and the financial peace journey that they're going on. So, hey, mate, I just wanted to say thank you very much for coming on today's show. I'm sure this episode will be listened to. You know, it'll have an evergreen element to it, right? Because ultimately, what we're talking about today, in a sort of a softer property market, and first home buyers, like everyone else, are a bit more challenged in today's market. But I suspect as, you know, interest rates eventually pause and the market starts to show some signs of life, your timing in terms of potentially releasing a product like this in the first half of next year could be quite interesting. And we'll obviously keep an eye on it and put any announcements out there for people once we know that the product is live, because it's really innovative. I really like what, you know, the critical thinking that's being done here. And I think there's definitely on both sides, there's an audience that you can serve on both sides. So credit to you and the team for putting all that information together, and we wish you all the best.
Thanks, Ben. Thanks, Bryce. It's been a pleasure being on the show.
Thanks for joining us, buddy.